The European Union continues to insist that an embargo on Russian energy supplies is imminent. Although there is nothing but threats yet, it's enough to make the market nervous. Investors are deeply concerned that the EU ban on Russian imports will be followed by energy market restructuring coupled with a complete grave turmoil and chaos. Most importantly, there is a risk of real energy shortages worldwide. So it's not surprising that the oil prices are still extremely high and tend to increase, although there is currently a slight decline, and this is just a slight pullback after an impressive and long-term growth. Thus, this movement is temporary, and there are no signs of a continued downtrend so far. If the European Union does not dial down its rhetoric, oil will most likely resume its bullish run within 1 or 2 days. From a technical point of view, Brent crude oil kicked off the new week with a 3% pullback. Thus, the price went down and fixed below the level of $110 per barrel. The pattern of sequential cycles is still valid in the market, and the levels of 100 and 115 serve as a wearable boundaries of the 4-week sideways range. As long as the range-bound trading continues, it's possible to trade with a view to catching a rebound and breaking through one of the boundaries. Oddly enough, growing fears about energy shortages as well as possible global hunger are driving the Russian currency up. After all, Russia is not only the largest energy supplier but also one of the top food exporters. Thus, in the event of a full-scale embargo from the West, most countries of the world could find themselves in an extremely difficult situation. They will have to circumvent Western sanctions and buy the necessary products from Russia directly, bypassing the European Union financial system. That's payments will be conducted in rubles or the national currencies, and this is what contributes to further rally in the Russian currency. Against this background, the behavior of gold may seem weird. The yellow metal has already fallen below $1,800 per 3 ounce. Moreover, gold has been trading downwards for about a month. Gold futures have lost about 10% over this period, signaling short-term oversold conditions, and this may lead to a temporary reduction in the volume of short positions and consequently a technical rebound. Global risks remain high, and this could stem from a focus shift among major investors. With the risk of a global energy crunch, safe haven assets are taking a back seat. In fact, they are becoming worthless, whereas basic commodities such as oil or grain are in a growing demand. Therefore, it will be possible to talk about a recovery in the gold market only after the geopolitical situation stabilizes. And that's all for now. We continue to learn developments on financial markets. Subscribe to our channel and follow news with us. See you soon.